Something unusual just happened in the silver market, and most people completely missed it. In the last 24 hours, silver didn't just move, it snapped. One moment it looked stable, almost boring, hovering in a tight range. And then suddenly, pressure built fast. Prices dipped, sentiment shifted, and traders started asking the same question again. Was that just a normal pullback, or the start of something much bigger? Here's what makes this moment different. Silver isn't just reacting to one factor. It's being pulled in multiple directions at the same time. On one side, you've got a stronger US dollar putting pressure on metals. On the other, rising uncertainty in global markets that usually pushes investors towards safe haven assets like silver and gold. And that creates tension, because silver sits in a unique position. It's not just a precious metal, it's also an industrial metal. That means it reacts not only to fear and financial stress, but also to expectations about economic growth, manufacturing demand, and technology sectors like solar and electronics. So when silver moves, it's often telling you a much bigger story. Right now, the US dollar has been showing strength again, and historically that's a headwind for silver. When the dollar rises, metals priced in dollars tend to weaken. But here's where it gets interesting. Despite that pressure, silver hasn't completely broken down. Instead, it's been holding key levels, even after sharp intraday moves. That kind of behavior usually signals something important beneath the surface. At the same time, interest rate expectations are shifting. Markets are trying to figure out what the Federal Reserve will do next. Will rates stay higher for longer? Or are we getting closer to cuts? That uncertainty alone is enough to create volatility in silver, because silver is extremely sensitive to real yields. When yields rise, silver struggles. When yields fall, silver often rallies fast. And then there's geopolitics. Tensions in global regions haven't gone away. In fact, they've been quietly building. And every time uncertainty rises, even slightly, investors start looking for protection. Gold usually leads that move, but silver tends to follow. And sometimes it moves even more aggressively. So what we're seeing right now is a market caught between opposing forces. Short-term pressure from a strong dollar and rate expectations, versus longer-term support from uncertainty. It accelerates, fast. And the real question now is simple. Are we looking at the beginning of a deeper pullback, or the setup for the next breakout? Move forward, because in the next part, we're going to break down exactly what caused this sudden shift in silver, and the key triggers that traders are watching right now. So what exactly triggered this sudden shift in silver? To understand the move, you have to look at how multiple forces collided at the same time, and one of the biggest catalysts came from political signals, especially surrounding Donald Trump and his latest speech. Now, whenever Trump speaks about the economy, trade, or the dollar, markets pay attention. Not just because of politics, but because his stance often signals potential policy direction. And this time, his tone was clear. He emphasized economic strength, pushed back on weakness narratives, and reinforced the idea of maintaining U.S. dominance in global trade and currency power. That kind of messaging has a direct impact on the dollar. And when the dollar reacts, silver feels it almost immediately. Following the speech, the U.S. dollar gained strength. Investors started leaning toward a higher-for-longer mindset again when it comes to interest rates. That shift matters because it changes how money flows. Instead of moving into metals like silver, capital starts rotating into yield-bearing assets. That's where the pressure began. At the same time, Treasury yields were ticking higher. And as yields rise, holding silver becomes less attractive in the short term, because silver doesn't pay interest. So when investors can earn more elsewhere, they temporarily step away from metals. But here's where things get more complex. Even as silver dipped, it didn't collapse. That tells you something important. This isn't panic selling. It's controlled movement. And that usually means bigger players are still watching, still positioning, and not fully exiting. Now add another layer to this. Industrial demand expectations haven't disappeared. Silver is heavily tied to sectors like solar energy, electric vehicles, and electronics. And long-term demand from these sectors continues to grow. So even if short-term macro pressure pushes prices down, there's still a strong fundamental base underneath. This creates a push and pull effect. Short-term traders reacting to headlines, while longer-term investors quietly wait for better entry points. And that's exactly what creates volatility like we've just seen. There's also something else happening behind the scenes. Market positioning. When too many traders lean one way, even a small catalyst can trigger a sharp move in the opposite direction. That's why silver can drop quickly, and then snap back just as fast. It's not just about news, it's about positioning. And right now, positioning in silver looks sensitive. So when you combine a stronger dollar after Trump's speech, rising yield expectations, ongoing geopolitical uncertainty, and stable long-term industrial demand. You get exactly what we're seeing, a market that's unstable in the short term, but not weak overall. And that distinction is critical, because many traders make the mistake of confusing volatility with weakness. But in silver, volatility often comes right before expansion. The key now is watching whether this pressure continues or starts to fade, because if the dollar strength slows down, or if rate expectations shift again, silver could quickly reverse direction. And when silver reverses, it doesn't move slowly, it accelerates. Move forward, because in the next part, we're going to look at the technical side of silver, key price levels, support zones, and the signals that could tell us where the next big move is heading. Now let's break this down from a technical perspective, because this is where things start to get really interesting. Silver right now is sitting at a critical point on the chart. Not just a normal level, but a decision zone. And whenever silver reaches these zones, the next move tends to be sharp, not gradual. What we've seen over the last few sessions is a rejection from higher levels, followed by a pullback that tested support. But here's the key detail. The support hasn't fully broken. That matters, because in technical terms, holding support after a sharp move usually signals that buyers are still present. They may not be aggressive yet, but they haven't disappeared either. Now, traders are watching three major zones. The first is the immediate support area, the level where silver recently bounced. If price continues to respect this zone, it suggests that the downside is limited in the short term. But if this level breaks cleanly, it could trigger a cascade of selling, especially from short-term traders and algorithmic systems. The second zone is the resistance level above, where silver previously struggled to move higher. This is where sellers stepped in last time. If silver manages to climb back toward that area and break through it, that would be a strong signal that momentum is shifting back to the upside. And then there's the third zone, the breakout level. This is the level that, if broken, changes everything. Because once silver clears a major resistance zone with volume, it tends to accelerate rapidly. Not in small steps, but in fast, aggressive moves. That's just the nature of silver. It's more volatile than gold, and when momentum builds, it often overshoots expectations. Now here's another important factor: volatility compression. Before big moves, markets often go through a phase where price tightens, ranges get smaller, and momentum looks weak. That's not weakness, that's pressure building. And right now, silver is showing signs of that compression. The recent whipsaw movement, the quick drop and partial recovery, is often a sign that the market is clearing out weak positions. It shakes out traders who are over-leveraged or positioned incorrectly. After that process, the market usually chooses a direction. So the question becomes, what direction is more likely? If the dollar continues to strengthen and yields keep rising, then the pressure on silver could push it toward a deeper correction. In that scenario, breaking support would open the door to lower levels quickly. But if the dollar stabilizes, or if rate expectations shift even slightly, silver could rebound fast, retest resistance, and potentially move toward a breakout. And here's something experienced traders always watch: reaction, not prediction. It's not about guessing where silver will go. It's about watching how it behaves at key levels. Does it bounce aggressively from support? Does it struggle near resistance? Does volume increase during moves? Those signals tell you more than any headline. Right now, silver is not trending strongly in one direction. It's coiling. And coiling markets don't stay quiet for long. They expand. And when silver expands, it often catches people off guard, especially those expecting slow, predictable movement. So what we're seeing right now is a setup. Not confirmation, but preparation. A market building energy for its next move. And that move could come faster than most expect. Move forward. Because in the next part, we're going to zoom out and look at the bigger picture. How global demand, supply constraints, and institutional activity are shaping silver's long-term direction. Now let's zoom out, because if you only focus on short-term price moves, you miss the bigger story that's quietly building in the silver market. And this bigger story is where things start to get very interesting. Silver isn't just being driven by traders reacting to headlines. It's being shaped by long-term forces that don't change overnight. These are structural trends, and they tend to have a much stronger impact over time. The first major factor is industrial demand. Unlike gold, silver is deeply tied to the real economy. It's a critical component in solar panels, electric vehicles, semiconductors, and a wide range of modern technologies. And as the global push toward clean energy accelerates, demand for silver continues to rise. Solar alone is a massive driver. Each solar panel requires silver for its conductive properties. And with countries investing heavily in renewable energy, this demand isn't slowing down. It's increasing year after year. That creates a strong underlying foundation for silver prices. Now combine that with supply constraints. Silver mining hasn't been expanding fast enough to match growing demand. In fact, in many regions, production has been relatively flat, while demand has been climbing. That imbalance creates pressure, and over time, it can lead to tighter supply in the market. And when supply tightens while demand grows, prices tend to respond. But here's where it gets even more important: institutional interest. Large investors, funds, and even some central players have been paying closer attention to silver again. Not just as a precious metal, but as a strategic asset tied to future industries. And institutions don't move like retail traders. They position early, quietly. They accumulate during periods of weakness, not during hype. So when silver experiences pullbacks like the one we've just seen, it's often not the end of a move. It can be the beginning of accumulation. And that's a key distinction. Because while short-term traders may see volatility as a warning sign, institutions often see it as an opportunity. There's also another layer: global economic uncertainty. Even though the dollar has shown strength recently, the broader macro picture is still unstable. Debt levels remain high, inflation hasn't fully disappeared, and geopolitical tensions continue to simmer in the background. In that kind of environment, metals like silver and gold tend to stay relevant. They act as a hedge, not just against inflation, but against uncertainty itself. So when you step back and look at the full picture, you start to see two timelines forming. In the short term, silver is reacting to dollar strength, interest rate expectations, political signals. But in the long term, it's being supported by rising industrial demand, supply limitations, institutional positioning, global uncertainty. And when those two timelines collide, that's when major moves happen. Because short-term pressure can only hold for so long if long-term demand keeps building underneath. Eventually, one side wins. And historically, when silver aligns with strong demand and tightening supply, the upside moves can be aggressive, much more aggressive than most expect. So while the current market might look uncertain, even confusing at times, the bigger structure behind silver remains intact. And that's what smart money is watching. Not just where silver is today, but where it's likely to be months from now. Move forward, because in the final part, we're going to answer the most important question: what happens next for silver, and how traders and investors are positioning for the next big move. So now we come to the most important question: what happens next for silver? Because at this point, the market has shown its hand, but only partially. What we know right now is this: silver is not weak. It's conflicted. On one side, you still have pressure from a stronger dollar and uncertainty around interest rates. As long as yields remain elevated, silver will continue to face short-term resistance. That's just how the market works. But on the other side, the bigger forces haven't gone anywhere. Industrial demand is still rising, supply is still tight, and global uncertainty is still very real. So instead of a clear trend, what we're seeing is a transition phase. And transition phases are where the biggest opportunities and the biggest mistakes happen. Now, traders are looking at two main scenarios. The first scenario is continuation of pressure. If the dollar keeps strengthening and rate cuts get pushed further out, silver could break below its current support levels. And if that happens, the move lower could be sharp, not gradual. Because once support breaks, momentum tends to accelerate on the downside. That's the risk side of the market right now. But then there's the second scenario, the one many are quietly watching. If the dollar stabilizes, or if the market starts pricing in rate cuts again, silver could reverse direction quickly. And when silver reverses, it doesn't just recover, it often surges. That's because silver is a momentum-driven market. Once buyers step in with confidence, price can move fast, breaking resistance levels and triggering a wave of new entries. And this is where positioning becomes critical. Smart traders aren't chasing every move. They're watching key levels. They're waiting for confirmation. And most importantly, they're managing risk. Because in a market like this, volatility can work both ways. Now here's something many people overlook. Silver rarely gives you a perfect signal. It doesn't ring a bell and say, "This is the bottom," or "This is the breakout." Instead, it creates uncertainty, hesitation, mixed signals. And that's exactly what we're seeing right now. Which means the next big move, whether up or down, will likely catch a lot of people off guard. But those who are prepared, those who understand the structure behind the market, they're the ones who benefit when that move happens. So the real takeaway here is simple. Don't focus only on the noise. Watch the key levels. Watch the dollar. Watch interest rate expectations, because those are the drivers that will decide silver's next direction. And once that direction becomes clear, the move could be fast and significant. If you found this breakdown helpful and want to stay ahead of every major move in gold and silver, make sure to subscribe to the Stephen Clark and turn on notifications. We break down the market in a way that actually makes sense, so you're never caught off guard when volatility hits. Because in markets like this, information isn't just power, it's protection.